So normally there's music with that. I didn't hear any music, but good afternoon, everybody. Welcome to the Wednesday edition of 7 Investing Now. My name is Daniel Brooks Kline, but you can call me Dan. I am fresh back from gambling. A little piece of advice here. Don't get laser eye surgery and then try to play blackjack a few days later. Not a great idea. I'm joined today by Steve Symington and Simon Erickson. Steve, there's snow at your place? What is going on here?
Yeah, we had record snowfall. It was kind of interesting to watch. We went from like a skiff of snow to 14 inches overnight. It was kind of wild and had a lot of trees that were struggling to support the weight. But hey, it's Montana.
Oh. Yeah, I gotta say. So, Simon, from that terrible news, because snow is like the worst thing imaginable as far as I'm concerned, let's talk about some good news. This podcast, we kind of won an award. You want to talk about it a little?
We did. We were voted as one of the top 20 investing podcasts by the Investors Podcast Network just this last week, Dan. That's the 7 Investing Podcast, publishes every day. Of course, includes your 7 Investing Now live stream on Monday, Wednesday, and Friday. And we also have interviews with industry leaders on Tuesdays and Thursdays. We're honored. We're excited to have that award. Thank you very much for it.
It is nice to be recognized this early on. But guys, we're going to hit it pretty hard today. The market is not doing well. It hasn't done well for the past 3 days. And it's one of those things where when this happens, social media fills up with people being worried. So our lead story today is going to be about the market. We're, of course, going to follow that up with what we're watching, where we're going to look at some earnings news and AMD on the move again. Then we're going to talk about the biggest IPO ever, in theory, Ant Group. And, of course, after that, we're going to hit our finisher. But guys, the stock market is crashing. The sky is falling. People are running around on fire. There's zombies. It's not good. Actually, it's just fine. Simon, how do you handle really bad days in the market?
The sky is not falling and there are no zombies. This is actually totally normal for the market volatility to be like this. It is the admission price of investing in the stock market to have volatility. And what does that mean? Dan, we are kind of hardwired as human beings to be adverse to losses. We don't like it when our portfolio goes down. We only like it when it goes up, but that's kind of how the way the market works sometimes. And so when things like this happen, it's great for long-term investors because the prices that you're paying for the stocks that you want to be in are now lower today than they were the day before or the week before. And so what I always recommend when there's volatility in the market, don't stress out over it. Have a watch list ready and be prepared to pull the trigger if you're ready on positions that you want to build for the longer term.
Steve, do you have a watch list? Is this a buy opportunity for you?
I always have a watch list. It's, at any given moment, I probably think about 100 different stocks that I'm watching pretty closely. And the comment they're displaying right now from Silvertrap, 0% interest rates, nowhere to go, all noise. Tell me what to buy. That's an interesting point because low interest rates tend to discourage investments in fixed income investments. So it encourages people to own equities. But yeah, like Simon said, this is one of those things that it's short-term in nature. This is completely normal. I actually tweeted something just before the show to remind people that on average, the stock market falls by 10% once every year or so. And of course, we had the big pullback in March, but we also see 20% pullbacks every 5 years, 30% once per decade, 50% a few times per century. This is a feature, not a bug for the market. And, it all depends. It changes what causes it, but it's certainly normal.
Sandeep David says, I use the 7 investing recommendations as some sort of a watch list. Yeah, that is a great place to start. Subscribe to 7 Investing and then figure out which of us you're like. I'm a little bit more conservative than, say, Max or Austin. Simon and Steve are more in the middle where they could have a risky pick. They could have a more conservative pick. This is a time to buy things at a discount. But Simon, let me throw this to you. We hear this one a lot. I'll see it posted on social media. I sold all my positions. I'm going to buy them again at a discount. That is like betting on a sale that you don't know is going to happen. Your thoughts there?
Well, stock prices in general, if we look at what's going on behind the scenes, they're typically a function of two things. One is the fundamentals of the company, right? So earnings, sales, or whatever the fundamental you're looking at would be. And then the multiple that the market is willing to pay of those fundamental earnings. And so there's kind of a part that's in your control as the company and a part that's out of your control. And the part that's in your control is how well your business is executing. And we're still seeing, post-COVID, especially for tech companies are growing subscription revenue at 30% or higher. And that's incredible right now. And the margins are expanding too as we're embracing cloud computing. So the performance of a lot of these companies is doing very well. The part that's a little out of the control is what multiple the market's going to pay for those. That's steadily expanded in the last couple of years, Dan, and it could very well contract in the next couple of years. We don't know what's going to happen, but focus on the things that are more important, which is running the business and the fundamentals rather than the multiple of those that the market's going to pay every day.
And Simon, let me follow up here. This is also one of those things where nothing has changed for most companies based on the market not A. And you're going to get pulled down just sort of like, the way a rising tide lifts all boats, so does a sinking tide. There's no pithy phrase for that. But it's really something you have to tune out, right? This is like a good company is still a good company no matter where the market went.
That's right. And we recommend that investors have a kind of a thesis of why they're actually buying into a company in the first place. And even better if you can have operational metrics that you're tracking on how they're performing. Not just the stock price, not just the price to earnings ratio that it's selling at, but how well is revenue growing? How well are operating margins expanding? What's the roadmap that the CEO has for the next 3 years? If you see a company that's doing well on those types of metrics, it's okay if the market's going to, zig and zag a little bit here and there. We want to find great companies and hold on to them for 3 or 5 years. Let's see. I don't know if we can hear you right now, Dan, but Tirth puts up a question of, in the current market environment, what do you think is more important, conviction or trading discipline and rules? Steve, do you want to take that one first?
Yes. I want to say first that we're not traders. When we're buying stocks, we're looking at these from a very long-term perspective. So that's something that we really need to keep in mind is don't try and trade this. Don't try and time the bottom. Another thing I included in my tweet this morning, and this might sound harsh, but it's really the assertion that if anyone says they know exactly when or where this pullback ends, they're either lying or ignorant, and nobody can time the market bottom. I can say that again. Nobody can time it with any reasonable degree of certainty. I think it's best to maintain a big picture view of what companies you're valuing and what they're really worth relative to their total addressable markets, and just stay calm and stay focused and buy businesses that you like anyway. So
perfect. And Dan, do we have you back on the show again? Are you with us?
I think we may have lost Dan. Oh, there he is.
There's Dan.
Yeah,
Hello again.
Sam has to let me back in. I had a little internet blip there. Guys, apologies. Just to summarize here, and you guys said it best, this is just how it works. Like it's kind of like a basketball game. Like if your team's down 20 points, that doesn't mean your team's not going to win. And that happens a lot in the market, where just today, there's a lot of companies where absolutely nothing changed for them, but they are not doing well. Don't worry about it. This is, of course, something we do at 7 Investing. We talk about this a lot. So what are we? We are a membership-based service. You pay $17 a month. We give you our best stock picks. But Simon, it's not just that. What else do you get as a member of 7 Investing?
Well, on top of $17 a month, Dan, you also have an annual option now for $170 a year, which by my math means you're getting 2 free months if you sign up for a full year in advance. So I think that's an even better than $17 a month bargain for my math, at least. But in addition, a lot of people say, okay, great, we've got these recommendations. What do we do with them now? And one other thing that we really provide with 7 Investing is continual coverage on our previous picks. We have subscriber-only calls where we actually interact directly with subscribers and our advisors every month, ask us questions about the companies. We provide updates on the important things going on out there. And then also really a look at what we see going on in the market. I think that it's really great to have a higher level perspective of what's going on out there, because that informs a lot of our stock picking as well.
So Simon, let me take a question here from Silvertrap, because it talks a little bit about our investing style. Then I promise we will get to AMD, we will get to upcoming earnings. And Silvertrap says, do you use technical analysis to get into a stock at 7 Investing? I don't. So I am let's call it an emotional investor. I want to be attached to a company and then really learn its fundamentals, really learn its management. So there are companies I really love that I don't invest in because when you dig in, you're like, oh, I really don't like the CEO there, or I don't like their strategy to make more money. But that's kind of how I do it. And management is really a big value. Do they have a plan? Do they know where they're going? Do they understand how to execute their business well? I ran retail stores, so I invest in retail when I see really excellent execution. Steve, your thoughts there?
No. I don't use technical analysis at all. And, that's to each his own, but I've found it's an unreliable way as a long-term investor to time entry points. It just doesn't make a lot of sense. I am looking at businesses as they're valued currently relative to their longer-term potential. And if you extend your investment timeframes, you greatly increase the chances of generating outsized gains. It's very difficult on a short-term basis in a matter of days, weeks, or even months to figure out exactly where a stock is going to be. But if you can figure out a company's chances to deliver on its longer-term market potential and watch its thesis play out over the course of quarters, years, then it becomes much more predictable. And if you can be patient to that end, then we've figured out each of us individually that that's the best way to invest, and you sleep a lot better that way too when you're not watching trends.
Simon, go ahead.
Can I add one more thing to that too? And that is, we don't do a whole lot of technical analysis. I do have a great amount of respect for those market technicians out there. But one data point that is interesting to our team is the short interest, which is the percentage of the publicly traded float of a company that's traded short, that people are betting against a company. That can be an interesting data point. I know you look at that a lot too, Steve, because great companies that are out of favor with the market could be an opportunity for the long-term investors.
Sure.
Yeah, basically it is about great companies and holding them for a long time. That's what we do. If you want to join us, it is 7investing.com/subscribe. Time for what we're watching. In this segment, Steve and Simon each picked one story. Steve, your story here, we're all focused on the election, but business hasn't stopped. This is still a pretty crazy week for earnings, right?
Yeah, it's a wild week for earnings against the backdrop of the election and COVID and headlines surrounding this ramping pandemic contributing to economic uncertainty. But we shouldn't let that overshadow the fact that this is the busiest week of earnings that we're going to see of the third quarter corporate earnings season. This week is kind of a who's who of big tech earnings reports in particular. Microsoft reported yesterday after the close. Shares, last I checked this morning, were down around 4%. And
despite the numbers being good, like that tells you everything you need to know. In a pandemic, their numbers were strong and they're down 4%. It doesn't.
Yeah, some people were looking at light revenue guidance. That sort of ignores the potential that they're under promising and will over deliver again when all is said and done next quarter. But I'm not particularly concerned. But tomorrow is going to be even more interesting. We're going to see Facebook, Amazon, Twitter, and Google parent Alphabet reporting earnings after the bell tomorrow. So it's going to be a wild day, potentially Friday, because there's going to be a lot to digest there. I won't be surprised, for one, if Amazon absolutely crushes expectations, even with the bar raised in many investors' minds, as it benefits from an accelerated shift toward e-commerce and demand for its AWS services increases. Facebook, Twitter, and Alphabet, on the other hand, are going to be interesting to watch. Some people were concerned from the Microsoft report that they saw declining search revenue and that might be a harbinger of bad things to come for Alphabet and Google. But
Steve, let me jump in. I think people are reading that wrong.
Yes.
Microsoft has very quietly cut a lot of people in Bing. Their whole search is not an important part of their business.
Right.
They downgraded MSN by, we've talked about this before, by getting rid of all the human editors. They've done a lot of that across their search area. I think this is an intentional downshift. That said, you're going to see weakness in the ad market. You're not going to see it at Facebook and Google because you know what they're getting? They're getting election money. Like there might be a subtle downturn. It's not going to be a big shift and it's going to be a massive recovery in the next quarter. But Steve, let me ask one question here and then we'll finish up, move into the AI arms race. what do you look for in earnings? I know that I personally look for the continuing narrative. Like if I'm looking at Microsoft earnings, I go, okay, what did Satya Nadella say last month? He said, well, we're focused on gaining new enterprise customers. And I'd go look, well, did they gain new enterprise customers? For me, it's not so much about the numbers. It's about, did the story develop the way they told me it was going to develop? Your thoughts here?
I think that's a great way to put it. One of the we have a couple seven guiding principles that kind of shift the way that we invest. And one of them is to develop a thesis for the companies that you're watching. That sounds silly to even say, but a lot of people don't have a thesis. They don't have a story. They don't know what they should be looking for each quarter when their companies report earnings. And it's very important to determine whether your thesis is still intact. But yeah, that's what I'm watching. So not so much headline numbers. You'll see knee-jerk reactions. That's usually what happens when they release and they say, oh no, revenue came in short, but earnings beat, or vice versa, or whatever, and the stock falls 10% or something. And it's silly. And I'm just looking for the story to remain intact. And as long as it does, and as long as the company is making notable progress toward delivering on that thesis, then I think that's when opportunities are created.
And stocks can rise and fall based on how charismatic the CEO is. And I'll give this example. Eddie Lampert at Sears, who's like the worst CEO there ever has been. For 3 years with earnings reports, every time they reported, the news would be terrible. And he'd put a spin on it. He'd be like, yeah, we're off 20%, but we really see a turnaround in socks. Socks was up 32% to start the next quarter. And the stock would go up. I wrote stories about this where every time after a bad earnings report, and I would talk titanically bad, like we've lost $3 billion, 2 of our stores are actively on fire, like our mattresses are just full of bed bugs, like everything would be bad. And he'd pull out some kernel, he'd be, of good news, and the stock would bounce the next day until a couple days later people would actually read the report and go, oh god, like they have like $100 left, like this isn't good, like I could pitch in and buy this company.
Reminded me of Radio Shack back in the day. They're like, we are pivoting towards cell phone cases and accessories. I'm like, oh goodness sakes. But
and that commercial with all the 80 stars during the Super Bowl does not seem like a good investment at this point. But Simon, we are going to pivot here. You want to talk about the AI arms race. AMD is spending money like it's not their own money. Tell me what's going on here.
Well, Dan, first of all, this is a 2-beer conversation, so I'm going to do my best possible to keep it brief and at least hit the high notes on this. The AI arms race is the way that you describe this right now. The semiconductor industry is continuing to consolidate. AMD just spent $35 billion to acquire Xilinx, which is a programmable chip company, a field programmable gate arrays. And this comes right after NVIDIA spends $40 billion to acquire ARM Holdings. We also saw Maxim Integrated Products just get acquired for $20 billion. These are big numbers, Dan. This is a lot of money getting thrown around in chips. And the reason is all of these chip companies are realizing that the data center that is serving those artificial intelligence workloads is very, very lucrative and very, very important. And so we're trying to diversify outside of CPUs, where we've seen Intel have some manufacturing issues for getting sub 10 nanometer chips. And so we're starting to look at different architectures out there. NVIDIA did this with its GPUs a couple of years ago. NVIDIA is one of the best performing stocks in the last 10 years. Companies are starting to wake up outside of CPUs. There's other options available for them.
So is this deal just about buying additional product to sell current customers?
It's about diversifying the buffet of options that can go out to the cloud computing service providers or the 5G telecom providers or whoever it is you're wanting to sell these expensive chips to. Xilinx can reprogram all of its chips. They're entirely customizable, which is really important for in terms of efficiency, right? So you've got all these power demands, all these operations going for the AI workloads, especially as we're approaching machine learning inference. All of that takes some horsepower. It takes a lot of computing horsepower, and you want to do that the lowest number of watts possible. And so what do? You go out and you expand your IP. You look at a whole bunch of different options. AMD has got a heck of a lot more customer relationships than Xilinx did. So you're leveraging some really awesome technology with a company that's got a lot of relationships with really good customers.
The first time I heard of Xilinx was this morning when I read the show prep document. Simon, do you expect more consolidation in this space?
Yeah, I mean, you've seen Broadcom try to acquire Qualcomm, for over $100 billion a couple of years ago. And, the numbers just keep getting higher and higher. Companies that we've never even heard of before are getting acquired for $10 billion these days. But again, this is an IP land grab, in my opinion. You want to have a diverse group of semiconductor options to build off of, serve the entire needs of a data center. This is like the most intensive computing that's being done across the world right now. And Dan, last time that I checked, AI workloads are going nowhere but up. So the demand for this is going nowhere but higher. I think that this is a great move by AMD to keep up with its large rivals of NVIDIA and of Intel.
And I got to say, I'm looking forward to Broad Qual Comcom. Like I feel like that is a company on the rise. Last question here: what's the investing takeaway? Have I missed this train?
This is an industry where the big get bigger. You want to look for companies that have got the powerhouse or the treasure of funds that's available to go out and make a $40 billion acquisition right now, because it's going to be really, really hard to compete against those companies. And again, I think that the other real big takeaway is look outside of CPUs. We've looked at CPUs as the processor of choice for so many decades now. Intel has built a completely dominant stranglehold on that market. But NVIDIA really made their name for themselves in GPUs, Xilinx and FPGAs. There's different architectures which are challenging that traditional model. And that's really keeping things interesting, that the hardware has to keep up with the software to keep up with all those AI workloads.
Guys, we are going to pivot a little bit, but I don't know if you can answer this question, but it's from our old friend, Joey Kline. No relation, spelled a little bit differently. But what are your thoughts on TSM? That's Taiwan Semiconductor.
Sure. So the foundries, the people that are making the chips, are going to benefit from all of these, because at the end of the day, they're agnostic to whatever the architecture is. CPU, GPU, whatever PU it is, even TPU, tensor processing unit that Google's making. Amazon's making its own Inferencia chips for AWS, like you mentioned earlier, Steve. There are a lot more chips out there. They're getting higher and higher price tags because they're doing more and more neat things. And the companies that make those, like Samsung, like Taiwan Semiconductor, the foundries across the world, those are going to be the most efficient ways to have them produced. So this is a huge win for a company like that.
Simon, is there a risk of disruption here? Could somebody come along with another way to do this that would, just absolutely rock the boat here?
I mean, to some extent, I've thought that Xilinx for years was the disruptor, Dan. This is a completely reprogrammable, configurable chip. If you do the engineering up front, you could have it do whatever you wanted to. And so before you have standards and codecs and things like this that become standard, as you're starting to use new code and test it out, you want to have something that you can make the tweaks to like that. And so that was the disruptive approach, right? It wasn't just, producing the most efficient CPU and you kind of get whatever you as close as you can to what your customers are asking for. And so now Xilinx is folding that into AMD. Of course, AMD has got a lot of options out there. I think that it shows that the creative new ideas in the semiconductor industry shouldn't be ignored, because the big guys are really paying attention to them.
Thank you for that. Now it's time to move on to what's going to be the biggest IPO of all time. So this is a billionaire tech tycoon, Jack Ma. Now, this is someone that Americans maybe don't know. He's one of the creators of Alibaba, but he's not particularly a high-profile guy in the U.S., but he's clearly an investing genius. Alibaba was one of the biggest IPOs ever, and now Ant Group is going to be a $34 billion IPO. But Simon, before we get into the why, what this company does, I'd like to know, is it strange that this is happening in Shanghai and duly in two Chinese markets, not in the U.S.? That doesn't traditionally happen, right?
It is. I'm not sure strange is the right adjective. It may be interesting, Dan. I mean, traditionally you'd have Alibaba list directly on the NASDAQ, right? Baidu listed directly on the NASDAQ. It's super easy for American investors to get access to these companies. This is the largest IPO. And in addition to that, it's not going to appear directly on an American exchange. You have to buy shares in Hong Kong or in Shanghai. And there's a lot of brokerages that can do that, Dan. We can talk a little bit about more of that if you want to, how you actually get shares of this. But it did, kind of raise an eyebrow that China's saying, no, we're going to keep the money within our walls and within the country here.
Well, how much of that is due to the current political unrest? That, we saw what happened with ByteDance, with TikTok, and sort of the very, very strong arm U.S. government tactics. This is a payment platform, and even though it doesn't operate in the U.S., there's a risk there, right?
Yeah, and a lot of this has been Chinese companies with accounting irregularity, Easy for me to say, Dan. Irregularities is what I'm trying to say. Luckin Coffee, right? Delisted from an American exchange because the numbers didn't add up. And we saw a lot of this in Chinese companies 5-10 years ago. This is not a company you're worried about having accounting problems like those other ones did. This is a massive IPO with a huge number of resources behind it that has chosen strategically to say, hey, China's got enough really large dollar investors. We're going to keep it here on the Chinese exchanges, not on the American exchanges.
Yeah, and Steve, let's get into the product a little bit. So Ant Group, their core product is Alipay. Talk a little bit about the problems that solves, and it sort of works a bit like a mix of a bunch of different U.S. products. So feel free to talk a little bit about what it does and sort of how amazingly large its addressable market is.
Oh man, Alipay is, I mean, it's enormous, and it's surprising to me. Not surprising, I guess, but this sort of highlights one of those things where you have a widely used product, catering to an addressable market with, over 1.4 billion people in its home country, and for perspective, the 34 plus billion that Ant Group is raising is going to give it a valuation of, I think, what was it, 310 billion. And for perspective, I think Square's market capitalization was like 73 billion last I checked. And, this is a mammoth company that a lot of people outside of China just haven't even heard of. And
let me give you let me interrupt with some of the numbers here.
Yeah.
Alipay had 731 million active users and handled 118 trillion won. That's about 17.7 trillion US dollars in payments during the past 12 months. Revenue is growing 43%. Basically, this product took a society that didn't have good banking solutions and gave them viable solutions. Simon, what are we laughing at here?
Wow, $18 trillion in payments processed, Dan. That's incredible. That is a huge company. The scale of this is unmatched by anyone out there, by no one else out there can keep up with them except Tencent. This is a two-horse race in China's e-commerce market, I think.
Mm-hmm.
So one of the questions we're getting asked here is, do we invest in recent IPOs? And I normally would say no. Like, I am not a fan of investing because you don't know enough about the company. You don't know management that well. You don't know how they handle things. In this case, I would actually say something different. Now, here's the reality. The brokerage I use isn't one that's part of the backing of this. So if I can buy shares, I would have to look at, does it go up 300% in day one? Well, maybe I'm not that interested then. But I do think this is an exception to the sort of traditional step away from an IPO because we don't know that much. Simon, your thoughts there?
This is one I would absolutely buy into. Typically IPOs, you look at them on a case-by-case basis. This is one that, like you just said, the numbers, Dan. I mean, look at what kind of moat is that? To have that kind of number of, 750 million users, growing still at 43% a year and $18 trillion in payments processing. I mean, that's as large of an economic moat as you can possibly have. It's going to be WePay and Alipay that are going to control China's e-commerce market. And just as more and more purchasing power comes online in this region, these are going to be the two horses that win. And this is something that I really think this company is worth a lot more than $320 billion 5 years from today. I would be supportive, even if it comes out high out of the gate. I still think there's such an opportunity for a company like this.
Yeah, their optionality is enormous because once you sort of control people's bank account, their ability to pay for things, there's all sorts of other things you could sell them. It's also, they can move out of just being in China. They can move into the rest of Asia. So this is one, a lot more about this. Now that being said, we don't know where we're going to be able to get it. We don't know exactly how it's going to work for everyone. And I probably still would read the S1 and get some of the numbers. But that said, this is not your typical IPO for a couple of $1 billion. Guys, what are they going to do with the $34 billion other than throw a really big party celebrating their IPO? Steve, any ideas?
I haven't looked into what they're going to use the proceeds for, but general operating costs, of course, and expanding in innovation. I mean, that's a lot of money for the company to use.
It's going to go into expanding their infrastructure, expanding their reach, expanding their marketing. It is expensive to grow market share, even when obviously some of it's going to happen via word of mouth. There's a lot of onboarding costs. Simon, I'll give you the last word here. Are you excited about this one?
I am. And I think a lot of that's going to go to acquisitions too, Dan. This is going to be the opportunity for them to make a play to put every opportunity possible on your web browser in China to get you to use e-commerce, to get you to buy things online. This is something that didn't exist in China 20 years ago. Now all of a sudden e-commerce is growing faster in China than anywhere else in the world right now. And so if they can go out there and acquire whatever company it is that makes it as easy as possible for you to click on the buy now button, that's just going right to the bottom line. That's I think acquisitions is where they put a good chunk of this $34 billion.
One more word on Silvertrap's question about investing in recent IPOs. Do we invest in recent IPOs at 7 Investing? The short answer is yes. This is one case where we're very interested, but we do have a couple of recent IPOs among our recommendations and subscribers will know which companies we're talking about, but we're very selective, and I think it's worth being patient. Sometimes it means waiting a quarter or two before we, kind of do that, but yes, in short, we do.
And 7 Investors, that's where as a member you learn that we're each different. We all have kind of our own style. I generally take the belief that, if I bought Amazon or Microsoft or any of the big tech high flyers 3 quarters in, I'd still be pretty happy about those acquisitions. You don't need to be there day one. Now, this is also one where there's less risk involved than there is with a typical IPO. We know a lot about this company. We know the management. It has a dominant market share. But guys, now it is time to hit our finisher. Sam Bailey, our producer, our marketing director, if you would like to share the graphic. We shared this one on Twitter. It was not our most votes. We usually get over 1,000 votes, so I don't know what happened here. But when I buy a stock, it's important that it's a brand I am proud to own. That was 25.3%. Good for a tie for second place. Stable with upside. That's my investing style. 34.9%. That was the winner. Risky with high upside. Tied at 25.3%. And at 14.5%, D, none of the above. Steve, which of these matter to you?
It depends on the company that I'm looking at. I tend to lean toward risky with high upside stocks, but I call it calculated risk. So, in this case, I probably would have picked a brand I'm proud to own. I like to, as we say, invest in good companies whose leadership we believe are a good company. It really depends on what I'm trying to accomplish. There's a lot of investors who are looking for that stable with upside niche, but that also means sometimes sacrificing potential returns and really big winners. So I don't mind taking some risk if it means I get to enjoy some outsized upside.
For me, a brand I'm proud to own is generally the foundation of it. That said, I have access to the 7 Investing recommendations, and I've been buying some shares of Max's picks each month in order to just have a counterbalance to my own investing style. So it's a little bit of a different strategy. I'm going to start writing about it a little, why I'm doing it, but that's just for members. You can join us at 7investing.com/subscribe. Simon, your thoughts here to close out the show.
Yeah, I chose option C, Dan. I chose the risky with high upside because, in my opinion, that those are the companies that aren't as well understood by the Wall Street analysts, and so their price targets are all over the place, and they outperform expectations. Maybe with an asterisk that it's got to have a good manager that can execute.
Guys, to close out the show, let's take this last question from Tirith P. How many positions do you hold at any given time in your portfolio? Is your list like a great company's watch list if we get 7 recommendations every month? Now, I think I have 12 at the moment. Some people have more. It's however many you feel comfortable with. And we're not telling you to buy all our recommendations. We're telling you to know what your needs are and then decide which of our types of picks are, maybe you really agree with what Simon's picking. You like those companies. He's backing up your resolution. Maybe you want a little more risk. So you're looking at Austin or Max and you're going, wow, I've never heard of these companies, but I just read their analysis and I totally agree with it. And I'd like to own a little bit of it.
Simon, how many stocks do you own?
What was the question, Steve? Were you saying?
How many stocks do you own, Simon?
Oh, gosh, man, it's way too many. It's tough for me to say that, though, because I take very small positions when I'm interested, and then I add to them over time. But there's a lot of small positions in there, Steve.
Mm-hmm. And Steve, you just own one, right? It's just a whole big position.
One single. No, I usually have 20 to 30 companies in my portfolio, but I'm actually increasing that a little bit. as we go through, because I'm buying a few of our recommendations every single month. And one of the things that I think is important to recognize is that a few big winners can dictate the massive amount of your longer term gains. So I don't mind placing smaller bets like Simon does, adding to them over time, but and letting winners run and cutting losers along the way. So
it's really what you're comfortable with. And it's also, it goes back to, we talk about this all the time. You don't have to check your portfolio every day. It's not important that you keep a regular eye. I recommend once a quarter, look at your portfolio. If there's something that's performing in an outsized way in one direction or the other, maybe figure out why. Oh, hey, they just reported really bad news, but it's correctable. Or, oh, the CEO was led away in handcuffs. That's probably not correctable. Might be time to get out. But that finishes up today's episode of 7 Investing Now. If you have questions for us, send us an email at info@7investing. That's the number 7investing.com. Or reach out to @7investing, again, the number 7investing on Twitter. For Simon, for Steve, I am Dan Kline. We will be back on Friday. I haven't figured out which of us are going to be on the panel. We have some interesting personal situations going on that might make it this panel yet again, or perhaps Austin will join us on Friday. Maybe we'll do it a big 4-person show like we did last Friday. Guys, thank you.